Welcome back to another video, and today I'm going over some more options trading strategies, explaining how you guys can make some massive returns in the markets. You guys might have heard of it. It's called a butterfly condor. This is one of, I guess you could call an advanced options trading strategy. However, I think it has some massive upside potential with very limited downside risk. Today, I want to focus on AT&T, and the reason why is because on these types of options trades, you want very low volume. And as you can see, I mean, over the last week, yeah, it has surged up about 3%. However, AT&T is typically a pretty non-volatile stock in comparison to other larger, more popular ones like Palantir, Tesla, like you name it. AT&T is a pretty calm, almost dividend stock. I mean, a lot of people really like their dividends. They have a really high payout yield, but that's irrelevant for this options trading strategy. And yet you can turn a very little amount of money, such as like $100 all the way up to like $2,400 if you plan this out right and it does hit. And now, again, I want to reiterate that you can do this almost any time, and it doesn't really need a certain market condition. However, you really would like low volume stocks because the more the underlying security moves, the more risky it's going to be on your end. So you want to keep the beta very low, and if you guys don't understand the Greeks and stuff, I really recommend you checking out the link below where I actually go over the basics in options trading and I explain some of the Greeks and stuff. So definitely check that video out. If you haven't already, like and subscribe, comment for those almighty algorithms. I really appreciate it. Now let's hop right into it. So here I brought up my small Robinhood account, and if you guys don't have options trading, highly recommend getting that. You have to fill out just this small survey. I did it like a year ago, so honestly I can't really remember, but they give it out to basically anyone who has a pulse. So just enable options trading. Just look it up on YouTube. I haven't made a video, but I'm sure other YouTubers have. Now essentially what you're doing in this option strategy is buying a bear call and a call credit spread. And then you are also going to buy a bull put spread and then a put credit spread. And as I said, it is known as an iron butterfly. So what you want to do is, of course, pick your security. I'm picking AT&T, as I've mentioned, and I'm going to go here to trade options. Now, you want to figure out what expiration date you're going to be choosing. I'm going to just choose the next one. This is May 7th. Today, as I'm filming it, it is May 3rd, so 4 days out for expiration. And you are going to essentially want to pick where it is going to close on that day. The closer you can get it to the actual close at 4 on that day, the better you're going to make more profit. So again, step 1, figure out your expiration, and then number 2, what price AT&T will be on expiration. And then you are going to want to pick that strike. So I'm just going to go out on a limb and say it is going to close around the $32 strike price. So I'm going to select this $32 strike. I'm going to sell a call at that strike. See, sell a call at this strike. And then the next step is going to be sell a put at the same strike. So I'm going to go back up here, sell a put at the same $32 strike price. Now, as you can see over here, I'm going to have the two options trades that I have selected, the $32 call and the $32 put. Then I'm going to want to buy a call, okay, where you are not going to think it's going to go above. Now, I want to reiterate that. You are going to buy a call at a price point that you do not believe the security is going to close above. So if it closes above, you're going to lose money. Likewise, on the next step, if it closes below, you're going to lose money. So basically, these are the outer boundaries. I'm going to say that it is not going to close above the $33 strike. So I'm going to buy this call. It's going to be over here. And then the next step is going to be buying a put, again, where you think it is not going to go under. You can go closer or farther. That is completely up to you. The closer you're going to go, the more profit you're going to make. The farther you go, the lower amount of profit you are going to make. And that is up to your discretion. As you can see here, these are all 4 of the options I will be buying and selling. So as you can see here, just to wrap it up, a $32 call, a $32 put, a $33 call, and then a $30.50 put. As you can see here, I'm going to get credited a total credit of $57. And now you got to remember that we're working in contracts, which is 100 shares. So you just take this 57 cents per share, multiply it by 100, which is going to be $57. I'm going to press continue. So for every single contract, I'm just going to go with the recommended limit price, just 57, so I can get filled. Right now, I'm filming this after hours, but, you know, good for the day, good till canceled. Let's just say good for the day just because of it. So I'm going to get a minimum credit of $57. Now I'm going to review order. I don't have enough cash in this small account right now, but you're going to need $150 worth of collateral. Now I want to change focus and go to the options profit calculator. Now I want to go back one page just so you guys can see where I'm coming from. So options profit calculator, link below, so you don't have to go and like find it or anything. But again, it's super easy. Options profit calculator, not that hard. We're going to go here and select this 4 legs. Now, we're basically going to input all of that information that we just put there. So just the stock ticker symbol, which is T for AT&T, we're going to select get price. So that was the closing price. Again, so step 1 would be to sell a call. So that would be equivalent to writing a call. So we're going to write this, and then we're going to go here and, of course, do the exact same thing that we just did. So we're going to sell that call at that price. So we're going to go to the call side here on the left. We're going to go down to that $32 strike price that we were talking about, and we are going to select mid. And then we're going to go down to leg 2. And again, leg 2 is to sell a put. So we're going to write a put. So go here to the right side, go down to the $32 strike price, and select the mid again. Then leg 3, again, the same leg, we're going to buy a call. So again, on the left side here, where I do not think it is going to go above, okay? So nothing above this, which we selected the $33 strike. Select the mid again, come back down. Now we are going to be buying a put for the last leg. So we're going to go here to the right side, and this is where we do not believe it is going to close under. And we selected the 30.5 strike price. So here in the mid again. Now, as we filled out all of our legs, we're just going to press calculate. We're going to agree and press calculate. And now this is going to give us a chart of our profit and losses. As we can see here, over the next 4 days until expiration, the closer it is to the actual strike, the larger profit we are going to have. As you can see, as we get farther away from our original 2 selling the put and the call, we are going to lose more and more money. And as you can see, of course, you can lose 100% of your investment. However, the nice thing about this option strategy is you have a very low investment, because as we can see here, the collateral is $150, but we are automatically going to be credited $57 right off of the bat. As we can see here, we are going to need $150 as collateral. However, we're going to get credited $57 right off the bat, which means that we're only going to need really $93. And the $93 is your risk. So the potential gains here are quite massive. So if you're risking $93 to make $55, that's a 57.9% return, and 57.9% return in 4 days is absurd. Again, with a very low volume security like AT&T, there is a big probability that it probably won't go out of those that range that you were focusing in. So if it does go outside of that range that we were focusing, we can lose 100% of our investment, which would be the $93 that we are essentially risking. The reason why I wanted to bring this to your guys' attention is because of the low capital that you actually need to trade these kinds of options and the high returns you can make very quickly off these options. And they offer great risk to reward ratios, in my opinion, where again, on these lower volume stocks that aren't going to shift a lot, you can make a lot of money quite predictably. Now, Robinhood is, of course, a 100% free brokerage to use in a sense of commissions and such. So when you're actually going to press send off to these contracts, you won't be charged a commission. However, if you're on any other brokerage, you might be. So just stay alert to that, because that can swing off your profit and loss. Not too much, but you know, when you're buying and selling 4 different options, those commissions can really rack up, especially if you're trading with a small account. Now, I really recommend looking at Options Profit Calculator before you send off any of these options, just to get a good visual and see where you are looking to aim. Now, the last thing that I want to leave you guys off on is that the max return is where you are selling the call and put. And if you are between your buys, you will be making money. So if you are outside of them, you are also going to be losing money. However, it is limited risk because your downside potential is capped, which is beautiful in options trading. Now, if you guys enjoyed this video, please drop a like. It really helps out the channel, and I really appreciate it. And of course, subscribe if you haven't been already. And I'll see you guys next time, and good luck in the markets.